SpaceX is a masterclass in storytelling, the smart money playbook, and psychology. The funny thing is, smart money or financial institutions aren't really that smart. They just know something that most of us don't. So in this video, I'm going to break down the hype around SpaceX, why it's working, and what you can do not to fall for it. We're giving in to our human nature to keep things simple if we're guessing and don't know what we're doing in the markets. Let's be honest, guys. People aren't buying SpaceX because it's a great company. They're buying SpaceX because it's Elon Musk's company and they've seen what he's been able to do with Tesla. So if we miss getting in on Tesla early, we definitely aren't about to miss out on SpaceX, right? Here's the beginning of a great story that people would pay top tier ticket prices to go see. If we do a little research, just a little bit, we can see the story that Elon sold to the Underwriters, which are the banks and publicly traded companies like Goldman Sachs, ticker GS, Bank of America Securities, ticker BAC, Morgan Stanley, ticker MS, and JP Morgan Chase, ticker JPM. These are some of the smart money institutions that bought all of the 555.6 million shares of SpaceX that Elon Musk wanted to sell to the public. Once they bought all the shares, Elon Musk successfully raised the funds he wants to use to grow SpaceX by going public. All through the headlines, all you could see was that SpaceX was going to IPO at $135 per share. We can see that right here on the 424B prospectus on the free Securities Exchange and Commission's website that the financial institutions were able to purchase the shares for less than $135 per share because of the fees they charge companies for the underwriting process of taking the company public to the market. So the banks actually paid $134.10 per share, not the $135 that was broadcasted all over the headlines. Here's the game, guys. Elon doesn't need to sell the public. He just needs to sell the underwriters, the banks, aka the smart money. But the best way to do that is to have the story already laid out, so the underwriters don't have to come up with one to tell the public. This is why the hype is so important to the narrative, a story worth trillions of dollars. Let the banks tell it, because the public aren't buying a company, they're buying a story. Since the banks don't plan on holding or keeping the shares long term, they could care less about SpaceX or any company in an IPO being profitable. They just need the valuation to be high enough to justify the stock price when it hits the open market. Hence, the $1.7 trillion valuation on SpaceX when the financials clearly tell the underwriters that it's an unprofitable company. Let's start with the first question that we should be asking ourselves. Why did Elon Musk take SpaceX public in the first place? The underwriters know why, but if someone plans on buying those shares, they better know why. Elon wants to use other people's money and the market value of SpaceX to purchase other companies, reinvest into SpaceX, restructure its existing debt, and use the market value of the company as compensation and leverage. But this isn't anything new in the smart money playbook. These are the main reasons that every company does an IPO. None of those moves, which is already showing up in the 8K filings on the SEC website, by the way, screams immediate returns on investment for SpaceX investors, purchasing the IPO price and higher right now. Meanwhile, Elon is using the money he was able to raise to build his company to purchase Cursor, aka Anysphere, and restructure debt issuing unsecured company bonds. The banks that are now holding the bag of over 500 million shares of an unprofitable company have to focus on making their money back. They're in a race against time because there's a temporary lockup period on other SpaceX shares that we'll get to a little later in the video. But they have to sell the shares they just bought from SpaceX to the public for more than what they paid for it, and fast. The shares hit the market on Friday, June 12th this year at $150 a share, giving banks an immediate 11.8% return on their investment. Since it hit the markets, it's traded as high as $229.85 in extended hours, which would be a 71.4% return on their investment in less than a month. The average trailing 10-year return from the S&P 500 is 12 to 15%. Keep in mind, these banks are getting roughly 12 to 71% off SpaceX, and all of this is happening in less than 30 days as of today's date, July 4th, 2026. So every single share they've sold so far has been for a profit. As long as the stock moves up while positive news drops about the company, the public will buy. That's part of the reason they call us dumb money. The majority of the public aren't buying companies. We're buying stories and headlines as long as the stock price is rising. The parts of our nature that we're fighting while in the markets involves our ego, ignorance, and our emotions. That's why when you first start trading and investing, making money on your first trade is the worst thing that can happen to you, because now your mind has some evidence to make you believe trading is easy or you're that good. We're wired to see results, but we have to think to see randomness. What I mean by that is if you do something once and it produces the result you want, it could be random, or in other words, luck. And we have to keep that in mind when we know we've achieved the result we didn't put in the work to consistently get. But when your ego gets you, you might make the mistake of giving yourself the credit for doing something right. And chances are you won't respect the risks involved in certain things until something happens that wasn't what you expected or prepared for. Next, there's ignorance. This is simply not knowing. You're not educated and skilled through a combination of study, practice, and experience. So when you guess and you get the results you want, since guessing work, chances are greater that you'll do it again. Lastly, there's our emotions. Something that's unique about trading is that fear can cause greed. There are people who avoid the markets because they have a fear of losing money. Then there are other people who have a fear of missing an opportunity to make money. It's called FOMO, the fear of missing out. But I believe the only reason someone would fall victim to FOMO is because they're not confident in their ability to find another opportunity. I want to focus on SpaceX specifically because I know that there are a lot of people who are experiencing FOMO every time they see this price go up on this stock. So I'm going to share with you what I've done to minimize making emotional decisions in the market. If you don't have a grounded process to determine which way a price should go, then you're guessing. The key word there is should, because we have no absolute way of knowing which way the price will go. For example, if a stock is trading at $50 and I think it's expensive or it's not going to go up, then I don't buy it. If it goes up to $60, now how do I feel about the decision I made when it was trading at $50? If my emotions get the best of me, then I begin to beat myself up for not buying it at $50 just because I saw that it went up to $60. But that's because I'm thinking that it's $10 more than I could have gotten it for. So I wait, and now it goes to $70. I'm really beating myself up now, but I still can't bring myself to buy it at $70, knowing I could have got it at $50 or $60. Then it goes to $80. FOMO activated. I jump in. I buy it at $80 because I don't want to miss out on any more money if the price continues to go up. Key word there is if. And what happens? Shortly after I buy it, the stock price starts coming down and I'm losing money. That's the result of someone trading and investing based off of their emotions and rising share prices in the markets. Here's what I did. I stopped making emotional decisions based on which way I thought the price was going, up or down. Stop making decisions based off that and started making logical decisions using a repeatable framework based on the value of the company compared to its current stock price. Here's how that works. Financials change every 3 months, but stock prices can change every time shares change hands. If I learn how to value a company for myself, then I know what the fair value of the stock should be, keyword should. So if my research tells me that a stock price should be at $45 and it's trading at $50, I'd be paying too much for it. All logic, no emotions. What if a week later, there are no new financial statements and that same stock is trading at $60 now? Now it's $15 overvalued. This becomes more of a reason not to buy it, not more of a reason that I should buy it. It doesn't matter how high it goes, $100, $500, $1,000. Based off my research, I just be paying even more for a company that's only worth $45 a share. This is what I've started using and focusing on to avoid FOMO and keep my emotions in check. Now, on the other hand, there's the falling price. And there's a saying in the markets, never try to catch a falling knife. There's another one that goes, you can't time the bottom. Notice that both of those sayings tell you to avoid buying at low prices, but the strategy that most people are familiar with is buy low and sell high. If I value the company stock at $45 a share and it's currently trading at $25, it's a buy. So I buy it. And a week or two later, it drops to $20. Am I upset and frustrated that I bought it at $25? Absolutely not. And why is that? I'm glad you asked, because at the time I made the decision, I had no way of knowing that the stock would fall to $20. But if the financials and my valuation of the company haven't changed and it was a buy at $25, it's really a buy at $20. If it goes down to $15, then it's really a buy. I know this sounds easier said than done, and that's because it is. I never said it would be easy. I only wanted to explain how it goes against our nature. So this is what's helping me avoid chasing stock prices with companies like SpaceX, for example. If I thought it wasn't worth $135 based on the current state of the company, paying anything more than that is even worse. Most people seem to be justifying the prices they're paying now based on what they believe the company will be worth in the future. Here's my take on that. Why would I pay Apple prices for Apple seeds? Shouldn't I only be paying Apple seed prices now if they're only Apple seeds now? I shouldn't pay Apple prices because I believe the Apple seeds will become apples. I don't want you to miss this analogy, so I'm going to make this even simpler. Hear me out. I'm about to go a little deeper. Seeds are potential, not a promise. Because apple seeds never turn into apples if they aren't placed in the right conditions. Once the investment becomes apples, then I'll buy it for Apple prices. But if I'm buying a company for the prices it should be selling for in the future, how am I supposed to make any money on my investment? I was talking about the fruit, not the company. But let's talk about Apple Incorporated, the company, ticker AAPL. Apple's market value is 4.5 trillion. Yes, that's T, trillion at the time of this video. And they've made over $122 billion in the last 12 months. Another way to say this is TTM, or trailing 12 months. SpaceX market value is 2.1 trillion. Yes, that's T, trillion. And they've lost over $9 billion in the trailing 12 months. Another way to look at this is that for every share of Apple someone owns, they are earning $8.27 per share every year or annually. For every share that someone owns of SpaceX, they are losing 72 cents per share Annually. This is laughable. I'm trying to say this with a straight face. Here's something else. The total ownership of SpaceX is divided over 13 billion shares. So the total pie of shares in SpaceX is 13 billion. This is going to be your outstanding shares. Over 95% of those shares haven't been sold on the open market yet because they're still in a lockup period. So when someone is trading SpaceX right now, they have over 12.5 billion shares that are not competing with you right now when you attempt to sell at a higher price, which means the price is artificially being held up at these levels based on the fact that the public supply is low, but only 555.6 million of those shares are trading on the open market right now, which is called the float. Remember, this is the reason underwriters, banks, the smart money are in a hurry to sell IPO shares they purchased to the public for more than what they paid for them. Way more than what they paid for them. Smart money knows that the average person isn't wired to buy something that's coming down in price because they're buying it in hopes that it will go up. Not to mention popular sayings that are misunderstood by people that hear them. Don't try to catch a falling knife should be interpreted as don't try to catch a knife just because it's falling. Look beyond the knife falling and value the knife's worth and where the floor should be. Keyword, should. But this can only be done after someone has looked into the business and determined if and when that knife is worth picking up. The bottom line is this, guys. Most of the public are too lazy to do their own research and aren't willing to put in the work to make better informed decisions. This is why headlines, narratives, stories easily influence the average person's decisions and cause them to lose more money than they gain in the markets. I stopped looking at headlines as information and started looking at them as advertisements. What are the institutions trying to get the story-driven public to buy or not buy, sell or not sell? I just focus on the tone of the story. Is this headline positive, negative, or neutral? Positive is a buy, negative is a sell, and neutral is a hold or confusion. That's it. When institutions want to sell us something, they need the price to increase or appear like it's holding. Without the positive news and a lack of buyers willing to buy on the ask, the price would fall and banks wouldn't make as much profit. So they produce positive headlines. So the public buying will hold and drive the price up while the institutions are slowly selling into the momentum. And the smart money don't just want to sell shares they purchase to the public. They want to sell them for way more than they paid for it. This is why I focus on doing the work on my channel. We have to do our own research, guys. That's the bottom line. All right. You already know. I hope that you learned something and I hope that you earned something. Thank you guys for joining me in this video. If you haven't done so already, do me a huge favor. Hit that like button and consider subscribing to the channel. Thanks in advance. I appreciate you. And this Sunday, July 5th at 9 p.m. Eastern Time, we're reviewing this week's performance of the 11 sectors in the S&P 500 index. Companies that stood out, notable market news, and performing a live Q&A so we can focus on building our community. And make sure you keep tuning in weekdays following a market trading session at 11 p.m. Eastern Time. I have some videos in the description that could potentially help you make better decisions in the markets. So make sure you check those out. Take care and God bless.